In 2016, if you had $10,000 in a Venezuelan bank account, you were middle class. By 2021, just 5 years later, that same $10,000 was worth $3, not $3,000. $3. And I'm not talking about some investment that went bad or a stock market crash. I'm talking about money sitting safely in a savings account. Now, here's the thing most Americans miss when they hear stories like this. They think, that's Venezuela. That could never happen here. And listen, I'm not here to tell you America is about to collapse or that you should panic and buy gold bars. But what did happen in Venezuela over the last decade wasn't some weird economic anomaly. It was the result of very specific financial decisions, both by the government and by regular people who thought their money was safe. Venezuela had 1,000,000% inflation between 2016 and 2021. Let me put that in perspective. If you bought a loaf of bread for $2 on Monday, by Friday, it cost $8. If your rent was $500 in January, by December, it was $15,000. That's not a typo. And the people who survived with their wealth intact weren't the ones with the most money. They were the ones who understood 7 specific lessons about how money actually works when everything falls apart. And those same 7 lessons apply to you right now, even if the economy never collapses. Because here's what I learned studying how Venezuelans protected their money. The strategies that work in a crisis are the same strategies that build wealth in normal times. You just don't notice them until it's too late. So in the next 20 minutes, I'm going to walk you through the 7 money lessons Venezuela taught the world and how to apply them to your life in America. Because whether inflation hits 3% or 30%, these rules don't change. Let's get into it. Quick intro if you're new here. My name is Jerry, and I make videos breaking down personal finance in a way that actually makes sense, without the guru BS or the invest in crypto and get rich nonsense. I'm not Venezuelan. I'm not a financial advisor. But over the last year, I've spent hundreds of hours studying how regular people in Venezuela, teachers, nurses, small business owners, survived one of the worst economic collapses in modern history. And what I found was shocking. The advice that destroyed people's wealth in Venezuela is the exact same advice most Americans follow today. Keep your money in a savings account. Don't take risks. The bank is the safest place for your cash. That advice got people wiped out, not because they were dumb, but because they trusted a system that couldn't protect them. So this video isn't about fear. It's about understanding how money actually works when the rules change. And trust me, the rules always change eventually. Let's go. Before we get into the lessons, let me paint you a picture of what actually happened. In 2014, Venezuela had the largest proven oil reserves in the world. Bigger than Saudi Arabia. People were middle class. They bought cars. They went on vacations, they saved money. Then, over the next 7 years, the currency collapsed. In 2014, 6 bolivars bought you $1. By 2021, you needed 4 million bolivars to buy that same dollar. Here's what that looked like in real life. A teacher making 30,000 bolivars per month in 2016 was making the equivalent of $5,000 USD. Comfortable. Not rich, but stable. By 2019, that same teacher, still making 30,000 bolivars each month, was earning the equivalent of $5 USD per month. $5. Now imagine that's you. You go to work, you do your job, you get your paycheck. But every month, your paycheck buys less and less and less. Your rent doubles, then triples, then becomes impossible. Groceries that cost $50 last month now cost $200. And your savings? That $10,000 you worked years to build? It's gone. Not stolen, just worthless. This is what happens when people don't understand the 7 lessons I'm about to share. But here's the good news. The people who did understand these lessons didn't just survive, they came out ahead. So let's break them down. Here's the first and most important lesson. If 100% of your money is in one currency, you don't have savings, you have a bet. In Venezuela, people kept all their money in bolivars, in savings accounts, in cash under the mattress, in checking accounts. And when the bolivar collapsed, all of it became worthless at the same time. Now here's what most Americans don't realize. You're doing the exact same thing. If 100% of your money is in US dollars, whether it's in a bank, under your bed, or in a checking account, you're making the same bet Venezuelans made. Now, I know what you're thinking, but Jerry, the dollar is way more stable than the bolivar. The US economy is the strongest in the world. And you're right, the dollar isn't going to collapse tomorrow. But here's the thing, it doesn't have to collapse for you to lose money. Between 2020 and 2023, the US had roughly 18% cumulative inflation. That means if you had $10,000 in cash in 2020, by 2023 it had the purchasing power of about $8,200. You didn't lose $1,800, but you lost the ability to buy $1,800 worth of stuff. That's the single currency trap. Your number stays the same, but what it buys shrinks. Here's what the Venezuelans who survived did differently. They diversified into multiple stores of value. Some kept dollars, some bought gold, some invested in property, some used Bitcoin. The point wasn't to bet on one thing, it was to spread risk across multiple assets. So here's the rule for you. No more than 70% of your net worth should ever be in cash or cash equivalents. The other 30%? Stocks, real estate, commodities, anything that holds value when currency loses it. Most people think diversification is for rich people. Venezuela proved it's for survival. Here's lesson 2, and it's going to make some of you uncomfortable. Your savings account is not keeping your money safe. It's slowly destroying it. In Venezuela, people watched their savings evaporate in real time. But here's the thing. It didn't happen overnight. It happened gradually, then suddenly. Let me show you how this works. In 2017, inflation in Venezuela was around 800% per year. That sounds insane, right? But let's break it down monthly. 800% annual inflation is roughly 18% per month. So if you had 10,000 bolivars in January, by February it bought you what 8,200 bolivars would have bought in January. By March, it was down to 6,700 bolivars in purchasing power. By December, your 10,000 bolivars bought what 100 foreign bolivars bought at the start of the year. Now, here's the scary part for Americans. This exact same thing is happening to you right now, just slower. The average U.S. savings account pays about 0.5% interest. Inflation over the last few years has averaged 4-6%. That means every year, your savings account loses 3.5% to 5.5% in real purchasing power. If you have $20,000 in a savings account earning 0.5% interest and inflation is 5%, you're losing about $900 per year in purchasing power. After 10 years, your $20,000 will feel like $13,000. Here's what Venezuelans learned the hard way. Cash is for short-term liquidity, not long-term storage. Your emergency fund? Keep it in cash. That's 3 to 6 months of expenses, maybe $10,000 to $20,000 depending on your situation. Everything beyond that? It needs to be working for you. In stocks, in real estate, in index funds, in something that grows faster than inflation eats it. The rule is simple. If money is sitting still for more than 6 months, it's losing value. Move it into assets that compound faster than inflation destroys. Because here's the harsh truth. The government isn't going to protect your purchasing power. Banks aren't going to protect your purchasing power. Only you can do that. Venezuela taught us that waiting too long to move cash into assets is one of the most expensive mistakes you can make. All right, lesson 3 is one that literally saved lives in Venezuela, and most Americans have never even heard of it. It's called the 3-asset emergency rule. Here's how it works. Your emergency fund should not be 100% cash. It should be split across 3 different types of assets, each with different risk and liquidity profiles. Here's why this matters. In Venezuela, people who kept their entire emergency fund in bolivars in a bank account got wiped out. When the currency collapsed, their safety net disappeared. But the people who split their emergency money across multiple asset types survived, and in some cases, came out ahead. Here's the formula they used, and here's how you should use it in America. Take your total emergency fund target. Let's say it's $15,000, 6 months of expenses. Split it into 3 buckets. Bucket 1, 50%, sure, 7,500. High liquidity, low risk. This is cash in a high-yield savings account. You can access it instantly. This covers immediate emergencies. Car breaks down, medical bill, lose your job. This is your first line of defense. Bucket 2, 30%, tier 4,500. Medium liquidity, medium risk. This is something like a short-term bond fund, a money market fund, or even a stable brokerage account. You can access it in 1 to 3 business days. This covers emergencies that last longer than a few weeks, extended job loss, major home repair. This is your second line of defense. Bucket 3, 20%, $3,000, lower liquidity, inflation protected. This is something like gold, silver, I-bonds, or even a small amount of Bitcoin if you're comfortable with volatility. You can access it in 1 to 2 weeks. This is the backup plan for the backup plan, the money that holds its value even if the dollar tanks. This is your nuclear option. Now, I know what some of you are thinking. Jerry, that sounds complicated. Why can't I just keep it all in a savings account? Because in Venezuela, the people who did that lost everything. The people who spread risk across multiple assets didn't. Here's the rule. If your entire emergency fund is in one place, you don't have an emergency fund. You have a single point of failure. The 3-asset emergency rule is how you build a safety net that actually works when the system doesn't. Here's lesson 4, and it's one most people completely ignore. In a high inflation environment, when you buy something matters as much as what you buy. In Venezuela, people learned this the hard way. If you needed to buy something, a refrigerator, a car, medicine, you bought it now, not later, because later meant it cost twice as much. Let me give you a real example. In 2018, a used Toyota in Venezuela cost about 500,000 bolivars. By 2019, that same car cost 15 million bolivars. If you had 500,000 bolivars in January 2018 and you waited a year to buy the car, you couldn't afford it anymore. But if you bought it in January 2018, you locked in the price, and the car held its value while the currency collapsed. Now, here's how this applies to you in America. Right now, inflation is higher than it's been in 40 years. That means the price of big-ticket items, cars, appliances, home repairs, is going up faster than your savings are growing. So here's the rule. If you know you need to make a major purchase in the next 1 to 2 years, and you have the cash now, buy it now, not later. Let's say you need a new car. You have $15,000 saved. You're thinking, I'll wait another year and save up $20,000 so I can get a nicer one. But if car prices are inflating at 8% per year, that $20,000 car next year will cost $21,600. Your savings grew from $15,000 to $20,000, plus 33%. But the car price grew from $18,000 to $19,440, police 8%. You're better off, but you could have been even better if you bought earlier. Now, I'm not saying go out and panic buy stuff you don't need. That's how people go broke. But if it's something you genuinely need, a washing machine, a roof repair, a reliable car, and you have the cash, waiting is usually a losing strategy in high inflation times. The Venezuelans who bought durable goods early, tools, appliances, vehicles, protected their wealth. The ones who kept cash and waited lost purchasing power every single month. Here's the rule: cash loses value, goods hold value. If inflation is above 4% and you need something in the next 12 months, buy it now and protect your purchasing power. Because in Venezuela, the people who waited didn't just pay more, they got priced out completely. Timing isn't everything in finance, but in inflation, it's close. Here's lesson 5, and it's the one that changed how I think about money forever. In a crisis, the skills you have are worth more than the savings you have. In Venezuela, doctors were making $5 per month. Teachers were making $3 per month. These were people with advanced degrees, years of experience, and savings. And it didn't matter. Their currency collapsed, and their savings evaporated. But here's what did matter. People who had practical, tradable skills survived. Electricians could fix things and get paid in food or dollars. Mechanics could repair cars and charge in goods. Bakers could trade bread for services. Plumbers, carpenters, hairstylists, anyone with a skill that people needed right now was able to generate income even when money itself was worthless. Now, here's the American version of this lesson. If you lose your job tomorrow, how fast can you generate income? Not from your savings, from your skills. If the answer is, I don't know, you're more vulnerable than you think. Because savings run out. Skills don't. Here's the rule I follow. Every adult should have at least one skill that can generate income within 72 hours of needing it. It doesn't have to be your career. It can be a side skill. Freelance writing, graphic design, tutoring, bookkeeping, handyman work, dog walking, Uber driving, selling stuff online. The point is, you need something you can turn into cash quickly if your main income disappears. In Venezuela, the people who survived best were the ones who could say, I don't have money, but I can do this thing you need. And that turned into food, into rent, into survival. Here's the harsh truth. Your job can disappear overnight. The company can fold, you can get laid off, your industry can collapse. But your skills, those are yours. And in a crisis, they're worth more than the $10,000 in your savings account. So here's what you do. Pick one skill, learn it, practice it, build a small portfolio or client base, even if it's just side work. Because the day you need it, it'll be too late to start learning. The Venezuelans who built side income streams before the crisis survived. The ones who waited didn't. Your savings will run out. Your skills won't. Lesson 5. Invest in yourself as aggressively as you invest in your 401k. All right. Lesson 6 is super practical, and it's something almost no one in America does. But every Venezuelan wishes they had done sooner. It's called the 30-day supply buffer. Here's the idea. You should always have 30 days worth of essential supplies at home. Not because you're a doomsday prepper, but because in a crisis, prices spike overnight and availability disappears. In Venezuela, grocery stores would get a shipment of rice or flour, and it would be gone in hours. People would wait in line for 6 to 8 hours just to buy a few items. And if you didn't have cash that day, or if you were at work, you just went without. The people who had stocked up weeks earlier didn't have to panic. They already had what they needed. Now, here's the math for you. Let's say your family spends $600 a month on groceries and essentials, so about $20 a day. A 30-day buffer means you keep an extra $600 worth of non-perishable food and supplies at home. Rice, pasta, canned goods, toiletries, cleaning supplies, medicine, the boring stuff you use every day. If you buy this during normal times, you pay normal prices. But if you wait until there's a shortage or a panic, you'll pay 2 to 3x more. Or you won't find it at all. Here's a real example from 2020 during COVID. Toilet paper normally costs about $0.50 per roll. During the shortage, people were paying $2 to $3 per roll on Amazon, if they could even find it. If you had a 30-day buffer before the panic, you paid $15 for toilet paper. If you didn't, you paid $60 or went without. Now multiply that across every essential item: food, medicine, cleaning supplies, batteries, and you start to see how much money the 30-day buffer saves you during disruptions. Here's the rule: build your buffer slowly. Every time you go to the store, buy one extra of something you use regularly. Extra box of pasta, extra can of beans, extra tube of toothpaste. Over 3 or 4 months, you'll have a full 30-day supply without even noticing the cost. And here's the psychological benefit. When everyone else is panicking and fighting over the last loaf of bread, you're calm. You're not worried. You already have what you need. That peace of mind is priceless. In Venezuela, the people who built buffers early didn't have to stand in lines. They didn't have to pay inflated prices. They didn't have to panic. The lesson? Scarcity drives prices up and availability down. The 30-day buffer protects you from both. Start building yours today. All right, final lesson. And this one surprises most people. International diversification isn't just for rich people with offshore accounts. It's for anyone who wants to protect their wealth from a single country collapse. In Venezuela, the people who survived best had money, family, or income sources outside Venezuela. Some had dollars sent from relatives in the US or Europe. Some had small businesses that sold to international customers online. Some had bank accounts in Colombia or Panama. When Venezuela's economy collapsed, these people had a lifeline. The ones who kept 100% of their wealth inside Venezuela lost almost everything. Now, here's how this applies to you. You don't need millions of dollars or a Swiss bank account to diversify internationally. You just need to think beyond US borders. Here's the easiest way to do this. Invest in international index funds. Something like Axis, Vanguard Total International Stock ETF, gives you exposure to thousands of companies across Europe, Asia, and emerging markets. If the US economy tanks, your international holdings can cushion the blow. Rule of thumb: 20–30% of your investment portfolio should be in non-US assets. Here's another option. If you have skills you can freelance: writing, design, programming, consulting, build clients in other countries. Get paid in euros, pounds, or other currencies through platforms like Upwork or Fiverr. This gives you income that isn't tied to the US dollar or the US economy. Or, if you're more advanced, open an account with a brokerage that allows international access, like Interactive Brokers. You can hold multiple currencies and invest in foreign markets directly. Again, you don't need to be rich to do this. You just need to think proactively. The Venezuelans who survived had optionality. The ones who didn't. Here's the final rule. Never keep 100% of your wealth in one country, one currency, or one system. Spread your risk. Diversify your income. Build lifelines. Because Venezuela taught us that no economy, no matter how strong it seems, is immune to collapse. All right, let's wrap this up. 7 lessons, 7 strategies, all learned the hard way by millions of Venezuelans who watched their wealth disappear. Lesson 1. Avoid the single currency trap. Max 70% in cash. Lesson 2. cash loses value faster than you think. Move money into assets after 6 months. Lesson 3. Build a 3-asset emergency fund for real protection. Lesson 4. In high inflation, buy durable goods sooner, not later. Lesson 5. Skills are worth more than savings in a crisis. Lesson 6. Build a 30-day supply buffer to avoid panic prices. Lesson 7. Diversify internationally. 20-30% of your portfolio outside the US. Now here's the thing. None of these strategies require you to be rich. They don't require you to be an investing genius. They just require you to think differently about money than most people do. And that's the real lesson from Venezuela. The people who survived weren't the smartest or the richest. They were the ones who understood how money actually works when the rules change. So here's my challenge for you. Pick one of these 7 lessons and implement it this month. Just one. Build your 3-asset emergency fund. Start a side skill. Buy that durable good you've been putting off. Add international exposure to your portfolio. Start small. Build momentum. Because the best time to prepare for a crisis is when there isn't one. If this video helped you see money differently, hit the like button and subscribe. I make videos like this every week, breaking down personal finance without the BS. And if you want me to dive deeper into any of these 7 lessons, drop a comment and let me know. Thanks for watching. I'll see you in the next one.